My name is Gareth Soloway, and I was a losing trader until I mastered technical analysis. Logic and charts beat hype and narratives every time. Now I teach investors the same techniques that made me a multi-millionaire. This is my trading game plan.
Good morning, everybody. Happy Friday. My name is Gareth Soloway, Chief Market Strategist here at VerifiedInvesting.com. And of course, this is my trading game plan. And in this, I focus on charts, probabilities, and trade setups. No hype, no nonsense. It is what it is. When you look at a chart, it has no narratives, it has no bias. It, again, gives you a price, a formation, and that's what we go off for, probabilities. All right, so let's dive right in here this morning, guys. Flipping over to the S&P 500. You can see, again, the S&P was kind of trending neutral to higher overnight. You can see right here, trending overnight. And then really just about 30 minutes ago, we had a nice little dump. And we've been seeing this very often. In fact, if you've been following these trading game plans, we've seen it pretty much around 9 a.m. each day. There's either a move up or a move down. I would say generally there's been more moves to the downside, which then are followed by retail buy the dippers. And this is something I wanted to point out here, folks. If we look at yesterday's price action on the S&P, you get these very sharp dumps, and then the selling stops and the buy the dipper retail come in, then another dump, buy the retail come in, dump, retail, bigger dump, and then retail sends us back up. And what we're seeing here, folks, and we can even go back a couple days, like look at this, folks. If we go back here and we move back to on Tuesday, look at how similar the price action is. You have these big dumps, and then the spigot gets shut off, and then we rise back up. And then big dump, we rise back up, dump, rise back up. And the reason I'm bringing this to your attention is what we're seeing here is more aggressive selling by institutions, but they still don't want to just basically dump and crash the market, right? If they do nonstop selling, it's going to freak out retail investors. And retail investors, right? If the market just kept going down and down and down, at some point retail investors get scared and they step away. But again, they're not being as inconspicuous as they were at one point, where they were just doing little bits to not really ruffle the feathers of the market. They're doing it much more like dump this whole block of S&P futures or dump this whole block of the S&P and then step back, right? And so it's a little bit of a change in character. To me, it tells me there's a little bit more urgency in the essential selling pressure from institutional money going on here. And again, just something I want you guys as traders and investors to keep an eye on. All right, now on a technical analysis basis, if we flip over to the S&P 500, this makes a lot of sense, right? We're very close to this massive high trend line here that we already tagged, and it caused a sell-off. We've obviously had a significant bounce back up. Markets today, again, are looking to open around the flat line. We were negative on that little dip in the futures, but we have come back. But essentially, if we go to our weekly chart and you ask yourself, okay, if this chart has the predictive power, which is based on probability, to isolate major market highs as well as major market lows, right? Well, then how much upside is really available if we're that close to this trend line? And the answer is very, very minimal. In fact, if we zoom in on this, right, and we do a measurement of the current price per yesterday's close to this trend line, there's about 1.6% upside till you tag that level. So if we kind of understand that, we can start to make sense of why our institutional investors and money managers aggressively dumping now a little bit quicker, right? They're not doing enough to really panic the market and crash it, because the retail, if they step back, retail will buy the dip back up. But they're certainly being more obvious about it versus prior, where they were just doing little bits to not ruffle the market's feathers. All right, so that's something to keep an eye on. The other thing too is, if we look at this chart of the QQQ, the NASDAQ 100, what we see very clearly is that you came right up underneath. This is called a retrace to the scene of the crime, right? And so again, I've shown you guys this before, but when you have a trend line, right? So this trend line here, you can see we hammered it here. We started way back here and right through here, and then we finally broke. When you have a trend line like that and price is hitting it over and over and over again and breaks, there's a tendency to come back. But the problem is here is that essentially what ends up happening is you come back to that line and then this now becomes resistance. So what was support here and here and here now becomes resistance, and you usually get a rejection of price. And interestingly enough, if we zoom in on this, we can see how that's kind of happening right there on the QQQ. Now we'll see if it extends itself to the downside, or do we just float on this Friday. Now, a few key tidbits to go over, right? So number one, at 10 a.m. this morning, in basically less than an hour, we will get the PCE data out, which is the favored gauge of inflation that the Federal Reserve uses. Now, right now, there's an 88% chance that the Fed will be cutting next week, which is almost as high as a sure thing, right? Again, there's no such thing as 100%, but 88% is pretty much a lock for the Fed cutting next week by 25 basis points. But again, you have to wonder about this US data now, right? It's very governmentalized. There's a lot of scrutiny from the president on this data. And I have a hard time believing that we'll ever get a bad number ahead of the Fed, meaning that, let's say, I think expectations for PCE are 2.9%. I would say there's probably a very tiny percent chance, like very small, almost nil, that the number comes in hotter than expected. If anything, it'll be in line or slightly lower. And the reason I say that is because if it was a hotter number, then they just wouldn't put it out, right? I mean, they have the whole excuse of, oh, the government was shut down, we don't have the data. They wouldn't put it out ahead of the Federal Reserve meeting next week. So what it tells me is the number will probably be good. But if I think that way, smart money is also thinking that way. And they might be looking at it and saying, okay, well, a good number here on PCE helps retail trust the market and buy, so we can then unload more into retail. So you always have to think about 4 steps ahead in understanding human psychology. And that, again, enables you to kind of understand the charts even more and more. All right, so QQQ, let's watch and see what happens today. Now, we do have something that I'm continuing to monitor. This is the Japanese 10-year yield. It's something I've talked with you guys about. Watch 2%. Okay, that to me is the line in the sand where the markets start to really get nervous here in the US. The 10-year yield in Japan is up again, albeit very little. It is up again, but the 2% threshold, again, is something that must be watched. And again, just to explain the yen carry trade, folks, basically, interest rates in Japan have been basically 0% for a long period of time. Just over the last year, they've started to spike and spike sharply recently, right? And the idea is that a lot of Japanese have taken literally trillions of dollars at 0 interest rates in Japan, and they've put it into US markets, being able to make 3%, 4%, or more by doing that. And that's the yen carry trade, essentially cheap money, meaning 0 or close to 0 interest rates in Japan, and parking that money in the US where they can get a better interest rate. It's essentially a freebie, right? Borrowing money here at 0 to make 3% over here for very little risk. The thing is, as those interest rates start to rise, there will be a certain amount of people that say, wait a minute, I feel more comfortable bringing my money back to Japan, essentially sucking liquidity out of the US market. Now, we're only at 1.95 on the 10-year yield. So yes, it's increased from 0% a few years ago to 1.95. But if that continues, there will be a reversion, a sucking out of liquidity from the US. Probably one of the reasons why the Fed is going to cut rates, because they have to counteract the liquidity crunch a little bit here in the US. All right. So just something to understand there. Now, Netflix. So Netflix is falling today. This is on the back of a deal being struck to buy Warner Brothers Discovery. All right. Now, the reason why, so number one, mergers, if they overpay, yes, the stock can get hit. But the reason why this is being such a negative force on Netflix, and has been for days now, because there was speculation of this, is because Netflix has a high premium. Their PE ratio is higher than Warner Brothers, Paramount, and these other players, because they always had the secret sauce. They had the secret sauce to why they could grow when no one else could grow, why they could profit when no one else could profit. The fact that they're willing to buy someone else out for $82 billion is telling investors we no longer, our secret sauce is essentially gone. That is going to bring the PE ratio down, and that is why Netflix is selling here. And look at this. So number one, it's down about 4% this morning, not a huge drop, but this is the chart that you got to pay attention to. Here's a trend line going back to October of 2023. Connects through the low in August 2024, in later in October 2024. In April 2025, we tagged it and bounced right here in November, and now we've broken it, and look at where we're trading today. All right, so for me, this is not just a break, a lower move. This is a major trend breakdown of Netflix. Now, listen, I'm not going to go short at Netflix at these levels, right? It's already been beaten down, but what I would do is not go long, and any bounces now are shortable levels when you hit key resistance, like a retrace to the scene of the crime. So just be aware, you have a breakdown on Netflix. It looks like it will confirm today. Amazing trend line has now been broken going back to October of 2023. And again, this stock is not in a good position, as the PE ratio should start to contract based on them becoming more like those that they're buying. All right, Apple. I gave you guys this level earlier this week, guys. All right, I said, guys, watch this level on Apple. It is a strong short. In fact, in Monday's My Trading Game Plan, I said, if we hit and pierce this parallel, that's your dead on short. I shorted it myself with members of Smart Money Stocks and ETFs at verifiedinvesting.com, and we already find ourselves in the money here based on this. And all I'm using is a classic parallel that happens to perfectly mark the major lows and the major highs. And look at what we hit. If we sell off today and close around 278, you will get a topping tail in addition. And a topping tail is a bearish reversal signal with the conjunction of a parallel tag or pierce. That is a very bearish sign for Apple. All right, so keep that on your radar. I continue to think Apple has likely topped in the near term and will be likely seeing a pullback to this high here first, around 258 to 260. NVIDIA continues to me, even though it's bounced the last few days, this looks more and more like what we would call a bear flag, down move like this and sideways consolidation here. And notice it's below this parallel. And so you had the parallel here marking our tops, and then the parallel also coordinates with the recent lows, right? And it broke down, and now it's got this bear flag formation. Now, we could see this retrace to the scene of the crime, which would be back to about 193, 194. But the idea is this setup, which is something we can use on almost any chart, right? I mean, patterns are continual reproductions over and over, just on a different chart. But the idea is here, this to me looks like it's forming a bearish flag pattern on NVIDIA. Microsoft here, folks. Microsoft's been in a tough spot. It has not performed well since it double topped over here in late October. I still see it coming down to this level. Notice the first bounce. Look at this, guys. So the first bounce perfectly off of this level, right? So you had your high from 2024, boom, and it bounces back up. Now, if it comes down again and breaches that, this is going to be your next level. Eventually, I see, and again, this is probably in 2026, I think we go down and fill this gap. Big gaps. Remember, the old adage in technical analysis is gaps are made to be filled. You don't know when, but when price starts to violate, like if we break these two levels, then that's really your next stopping point down here on Microsoft. And again, that could take some time because Microsoft's a big company. It would be somewhat rare for us to see a quick move down unless the markets really panic and sell. Amazon, watch Amazon here, folks. Key trend line from April lows through the lows in October, through the low in November. If this line breaks, you're going to get a bigger drop. Gap fill at 193 would be the target. Likewise, we have a major ascending trend line that if we rally, this would be your shortable level, right? So in terms of trades, I have no trade open on Amazon right now as a swing trade. I am watching it, but if we were to rally here, I would short this. And if we break here and then retrace to the scene of the crime, I would short it there as well. Would I buy this level? You could. Again, I'm not sure if I will. If I do, I need to keep a very tight stop at any break with confirmation of this level. Notice it broke here. It never confirmed, right? And so if it breaks here and you go long, let's say you go long at 223 for a bounce, because it could bounce again, but then it closes below and confirms, you got to accept the fact that it's broken and confirmed a breakdown, and you get the heck out of the way. All right, let's go into Bitcoin now, folks. We'll talk a little bit of Bitcoin. I'm hopeful to get into some questions end of session today from that you guys have been posting in the comments. Bitcoin is coming down for the second day in a row. This is one of the reasons why I'm monitoring the stock market as well. If Bitcoin starts to slip lower, then again, that would be a negative for the stock market as a risk-off indicator. Now, I've talked to you guys about this, right? So my max upside on Bitcoin is back to 100,000. That would be where we would hit major resistance. Now, remember, you could always break that level, but that's going to be like a major wall for Bitcoin if it gets there. The other thing we've talked about is the down move and what type of pattern formation are we getting. To me, this is looking very much like a down move, inside bar, bear flag. Remember, we've looked at a few of these already. Patterns repeat. That's the beauty of this stuff, is we can learn over and over again, or we can learn a pattern and then see it and make money off of it over and over again, as long as we understand it. So again, little downside on Bitcoin. I continue to hold a long with smart money stocks and smart money crypto members. We are in the money at this point, but again, watching to see, and I'll be unloading if it gets up into that 100K or just sub 100K level. Gold is inching up a little bit. Again, we talked about how this chart had broken out and confirmed, and then notice what it's doing here. And this is the beauty, right? So while we were in the wedge pattern, there was really like, okay, which way is it going to break? Is it going to break to the upside? Is it going to break to the downside? And ultimately, we wanted to see which way it breaks, and does it confirm? Well, once it confirmed a breakout of the wedge pattern, and we got confirmation, look at how price has now started to make bullish consolidation, right? That's bullish. We talked about this yesterday. That again, as long as you don't break this level here, that favors the upside move on gold in the near term. All right, looking at silver. Silver had that nasty sell yesterday. Again, not a nasty sell, but a nice sell there. It's bouncing right back. I still think silver has one more push in it to the upper trend line of the parallel. Then I'd expect a bigger pullback. This to me was more of a shakeout. Let's see if we can take out these recent highs around 59, 58.85. If we do, we should go north of 60, slamming into that level. Oil. I've talked about being long oil with smart money commodity members at verifiedinvesting.com. And of course, what we're looking at here is an attempted breakout. It has not broken yet. I want to see a breakout with confirmation. If that happens, we should see a big move up on oil, at least into the mid 60s, I would say. I went long down here at the low end of the parallel. So we're decently in the money at this point, but I'm looking for a bigger score on oil. Lastly, natural gas. It continues to march towards my upper zone. I threw in this new parallel for us. Notice how it coexists right up here. We are getting I repeat, very, very close to a level where I will take a starter position short on natural gas. All right. Now, again, I don't jump all in. I don't jump in the cold pool. I just dip a toe in to start. And again, that's very important. In my opinion, that has saved me many times, because things can always go above my levels, just like they can go below, right? I'm not infallible. I have my losses. I have my bad reads on charts, as we all do. It's all about probability. And so by inching in, I can mitigate some of that negative probability potentially by dollar cost averaging. All right. So watch this, but great move on nat gas. It is getting close to that 530 level per this chart. All right. We have a couple minutes for some questions, folks. So as always, I want to get into, when I have time, a few of these questions. Let me bring them up here on one of my screens. All right. Can you cover BMNR? So that's the Tom and Lee, I believe, stock that has like a Ethereum treasury. Yeah, sure. Let's take a look at it. And so needless to say, what we know about this stuff, guys, and we'll flip back to the charts and take a look at BMNR here, Bitmine Immersion Technologies, is, so number one, I remember when this had this big move, I showed you how it was going to collapse back down, and that's exactly what it did. It is creeping up, but essentially what we're seeing is, if you look and overlay the Ethereum chart and the crypto charts, it's essentially following that. Now, so what that means is that in general, I would feel better about analyzing the Ethereum chart, which we can do here. And Ethereum, I'm actually long with smart money crypto members as well, right off of this level. And so again, for me, Ethereum still looks okay. I still think there's probably further upside to go. Low end of the parallel, major technical support. If it ever breaks, it goes down here. But right now it's holding. And I think there's a little bit more upside here on this chart of ETH. And that probably means near term positive, slight positive bias on BMNR as well. All right, next question let's do here. Let's see what we have here. Gareth, can you look at FIG and share your thoughts? Not sure you have covered it before. It's bouncing after an 80% fall. Sure, let's look at Figma, FIG here. So Figma's a pretty new IPO. A lot of these have been crushed, guys. Again, it's amazing how they were so hyped up early on, and then they've cratered. One of my things to just mention, guys, is when an IPO is released to the public, I never buy it. You will never find me buying it. Listen, if I get in with the institutions before it becomes public, that's a different story. But when it becomes public, that's when the public can essentially jump in. I never go with the crowds, right? I don't want to be a sheep. I don't want to follow the herd. I want to make the herd go in a direction. Like I want to be the first one, not the last one. And so just my 2 cents on that is early in my career when I tried this, I almost always lost money. And I think we can all conclude by looking at this chart of Figma that aside from a few people that initially bought it and got out really quick, everyone else lost money, right? And so just be aware of that. Now, again, is this beaten down? Yes, but what I would suggest is don't stick around too long. And the reason I say that is I do think there might be some more upside if the markets can continue to bounce, but it could be forming a bear flag too. And so listen, this could definitely bounce. I mean, I think max upside would be back to this low, right? If we're talking technical analysis here, this would be epic resistance right here at 50 to 51. That would actually be a good sell into level. So, I mean, yeah, there's a potential to get back up there, but I would just monitor this pattern down here as, again, it could be a little bit of a bearish pattern formation. All right, next question. Let's get one or two more in. SMCI, so this is a chip stock. And you can see very similar chart to Figma in that the bear flag is forming. And so you're getting bounces here. But again, is that bounce really a quality bounce? I like to see more vertical and then buy the pullback. It shows me more interest. By the way, look at this great trend line I had already on my chart from a while back. And look at the breakdown that occurred. And then again, we kind of came right into support down here for this near-term bounce. But suffice it to say, this stock, again, is beaten up, but it is slowly working off that by creating the bear flag. Remember, bear flags go sideways to up. So if we look at a bear flag, you see a bigger drop on a stock, and then it starts to go and consolidate, and that usually leads to further downside. All right, so we just have to monitor that. That's the only thing that has me a little bit nervous. Yeah, sure, we could float up a little bit more, maybe back to 37, 38, maybe back to this low right here at around 39. But again, if that pattern is still there, it means keep it as a swing trade, not as a long-term investment. Or I shouldn't say long. Listen, long-term, who the heck knows? I'm not going to pretend I even have any clue where SMCI will be in a year, 2 years, 5 years from now. When I talk long-term, guys, because I'm a day trader and swing trader, long-term is like 6 to 12 months for me. I know for most people that's short-term, but for me, short-term is like a few days to intraday, like in and out in minutes or seconds. But again, watch the pattern. If the pattern makes you feel uncomfortable, then just get out. That's the beauty of it. We all have control. We don't want to ever give up on a trade we're in or even take a loss. I certainly hate taking losses, but it's part of the game we play. But ultimately, anytime you feel uncomfortable in a position, it's either telling you that the pattern is telling you the opposite of what you want to happen, or it's telling you you allocated too much capital to that position. And once you allocate too much capital, what happens? Emotion takes over, and the market now has the edge on us. Because again, once emotion takes over, the market can do whatever it wants, and it'll freak us out and make us make the wrong decision, right? It'll make us dump when we should hold. It'll make us buy when we should be shorting or staying on the sidelines. And so again, position size is probably the most important thing because it helps you keep logic and discipline in an otherwise wild market. And as long as you have logic and discipline, you have an edge on other investors. As soon as you lose that, it's over. Markets win. Might as well give your money to charity. All right, my 2 cents for today. You guys have a great one. Thanks for tuning in, guys. Much appreciated your time. Thank you for supporting us. If you wouldn't mind, share this with friends and family if you think they would find it advantageous and insightful. Have a great one. Take care.